Welcome to the Building Web3 Podcast. Today we're diving into how Zyvo is disrupting the $250 billion consumer lending market. We'll uncover how they're combating predatory lending practices, connecting on-chain liquidity with real-world borrowers, and democratizing access to credit. Remember, nothing stated here is financial advice. Welcome to the Building Web3 Podcast. Today we have my good friend Thor with me. He is the co-founder of an exciting startup called Zyvo. Could you give us a brief introduction into what you were doing before you entered the Web3 space, and what was your come to crypto moment?
Yeah, for sure. Well, first of all, Jax, thank you so much for having me on. I'm really looking forward to kind of talking a little bit about what we're doing at Zyvo. Before I maybe jump in a little bit about myself, just a super brief background on Zyvo. We are a real-world asset credit protocol focused on disrupting predatory high-interest consumer lending, and we do that by connecting on-chain liquidity with real-world borrowers. So a little bit about myself. I did a very brief stint in investment banking before Zyvo, and actually was originally exposed to crypto in the space back in 2017. So we had, kind of that big run up that was going on in 2017. Like a lot of folks, I was kind of drawn in by the price action and kind of just as interested as a trader. After having hung out a little bit, I kind of figured, I should probably begin to understand, the technology behind some of these things that I'm actually trading, and really fell in love with it and have been involved in the space ever since, just kind of learning, using it as an investor, and then also just kind of interacting with different protocols before finally taking the jump into actually building in the space about 2 years ago when we started building Zyvo. I had actually gotten talking with my father, who I ended up actually co-founding the company with, along with a couple other folks. And he had left a previous job he was at, where he was actually running one of the largest consumer lenders of its type in the country. And one of the things he realized there is that a portion of people who are falling into the non-prime consumer borrowing category are receiving loans at significantly higher interest rates than they should be. So a lot of people don't know this, but in the US, there's a $250 billion unsecured consumer lending market, of which about $20 or $30 billion actually have triple-digit APRs. And so what this looks like in practice is people who are maybe borrowing like $3,000 at a 300% APR. And that's a really common scenario. And that is, really what we're looking to address at Zyvo and how the company kind of came to be.
Awesome. And let's go over some of the terms, because people might not be as familiar with what is non-prime, prime versus non-prime.
Yeah, for sure. So credit is tiered, for those of you who are in the US, on a scale of up to like 850. And what happens is you have essentially different cutoff points where people assess your creditworthiness differently. So a prime borrower is going to be able to go get a credit card from like an American Express, for instance, and get that at a fairly reasonable rate. Non-prime borrowers a lot of times will find themselves in positions where they're not able to apply for credit from, companies that are more mainstream, such as like an Amex or something, and they don't necessarily qualify for personal loans from banks. And so what happens is when these individuals, and when I say kind of these individuals, it's half the adult US population is considered a non-prime, find themselves in a position where they need access to credit. Bad, good, or otherwise, the US and most of the world, we are a financial system that is run on credit. And access to credit is an indispensable fact needing access to credit is an indispensable fact of just being an individual in today's kind of world. And so what happens a lot of times is these non-prime borrowers who are unable to access credit at standard rates from, let's say, getting a bank personal loan, turn to alternative lenders. And these alternative lenders, a lot of times, are charging triple-digit APRs for people. And so if you find yourself in a position where, let's say, your car breaks down and you don't have enough in savings to cover it, like half the country in the US, I think the statistic now is, 50% of US adults can't cover $1,000 emergency, and you don't have friends or family you can borrow from, and you need money to fix your car this week or you lose your job. Well, what do? You go and you turn to one of these lenders. And so you might find yourself in a position where you're borrowing $2,000 at a really crazy APR. And it's an example we use a lot, but there's a really good Bloomberg article about a woman named Kimberly Richards. And she borrowed $2,500, a 276% APR, which, being in crypto, we're all probably used to seeing like crazy eye-watering numbers, but I think we can all agree that, someone borrowing at a personal loan at a 276% APR is crazy. And this woman paid back over $7,000 over the course of 2 years in interest and fees alone. So that's not counting principal repayments. And so what we're really focused on is helping individuals like Kimberly, who, what we know about someone like her is, being that she made payments on this loan for over 2 years, it paid back over 3 times the original value of the loan, is that she is displaying a form of creditworthiness that isn't necessarily being reflected in her kind of traditional credit score. So we would consider someone like her the target demographic that we're looking to help at Zyvo.
Yeah, those lending rates, I think, would even make the mafia blush. So that's a very exorbitant amount of money that she had to pay back. So let's talk a little bit about, how Zivoe works. So are you able to track their creditworthiness? How do you guys kind of, address this non-prime market and make it better?
Yeah, for sure. So what we are actually doing with Zyvo in order to actually make an impact in this market is we are essentially allowing crypto users or global crypto users to provide liquidity to the protocol. This liquidity is then actually lent out on chain to our lending partner. Our lending partner is a company called Inclusive, and they are a US-based fintech company focused on lending to this demographic. And a lot of the same people who are involved in Zyvo are actually involved in Inclusive as well. We have started out as one company and split into two to be regulatory compliant. So when capital is lent to Inclusive, they then actually take that capital off chain and use it to fund more affordable consumer loans to this particular target demographic. And originally what we're actually going to be focused on doing is refinancing these loans into lower. So we can take people like Kimberly from, let's say, a loan at 276% APR into something that would be like a 60% loan, and then all the way eventually down to a 36% or lower loan over time. So once that capital is lent to them on chain, they take it off chain, as I mentioned, and use it to fund consumer credit products. And then those products are actually placed into an SPV. And for those who don't know, an SPV is simply the acronym is for a special purpose vehicle. And it's just a legal entity that's set up for a very specific purpose. And in our case, that purpose is actually custodying these consumer credit products because it gives the protocol rights into the portfolio in a secured manner, protecting it in the event that there's counterparty risk or, something unforeseen on that front.
Absolutely. I think that this was a good walkthrough. Let's go through this kind of again and say like the life of a transaction, the life of like Kimberly trying to seek some kind of funding. So Kimberly comes up, does she go to the website? Does she connect her wallet? How does it work from her getting her loan to paying it back and then all the way up to that special purpose vehicle?
Yeah, for sure. So originally, we are essentially going to be providing a full Web2 experience to people who are these end borrowers like Kimberly. And eventually we would like to move them more and more on chain. But I think one of the things is right now is, we have to meet people where they are. And, 99.9% of consumers don't necessarily care, what technology is behind their, application or the website they're using, whatever it may be. Most people just don't care about, the tech stack behind it. You and I do because we're sitting here and, we're kind of tech nerds and this is what we enjoy talking about. But for most people, it's, does it accomplish what they're looking for in a really, user-friendly manner? And so in order to accomplish that, That is why we're working with Zinclusive, because that actually allows us to give these borrowers a normal Web2 borrowing experience without ever realizing that, their loans are being funded via crypto. And that was done really intentionally to allow us to essentially give them this normal experience. And then over time, we would like to move it more and more into Web3. With that being said, going back to the flow. So as a crypto user, what happens is, as you are coming to our protocol and you are a U.S. accredited investor, non-U.S. person, is you can deposit capital into one of two tranches. We have a senior tranche and we have a junior tranche. The junior tranche acts as first loss capital, but it has a slightly higher yield than the senior tranche. So when you deposit stablecoins in these tranches, you receive one tranche token for every stablecoin deposited, and those tranche tokens can be staked to claim yield. Once that capital is in the protocol, as I mentioned before, it is then actually provided to Zinclusive on-chain, and they're taking that off-chain. So like when Kimberly, for instance, comes to their website and gets a decision approved for a loan, capital that has been brought off-chain from the protocol is actually going to be used to fund her loan. And then she will have a completely normal loan kind of life cycle from there where, she's making payments through a typical Web2 portal, has a full Web2 experience. But as I mentioned before, that capital that she's actually been given has come from crypto.
Absolutely. And let's talk a little bit about, actually, I have to touch on this point because it comes up so often, is like, I'll meet with people and they'll be like, we have like a sharded modular blockchain. And you're like, okay, cool. But like, does it make people's lives better? And like us tech nerds, we kind of always tend to harp on the tech. So I really like that you guys are focusing on the Web2 and like the good UX experience. And then, my mother, she never comes to an Apple app. It's like, oh, is this using Swift? Like, and she doesn't know anything about programming language. It's just totally fine. So very good on the abstract part. So let's talk about what sets you guys apart from like other lending protocols in DeFi. And, it seems quite evident how you guys are different from traditional financial institutions, but let's talk about other lending protocols in the Web3 land.
So I think the thing that sets us apart from other RWA protocols specifically, I'm not going to kind of go into like go overanalyze some of the protocols like Aave because it's probably not a good direct comparison, but in the RWA space, I think what really sets us apart is actually just our experience in a way. So I am kind of the more crypto native individual on the team, but a lot of our team has background in TradFi, specifically in consumer lending, and have managed really large portfolios in the space. Actually, the last company our founder worked at, they had $1 billion consumer loan portfolio out on the street. And so what we feel really differentiates us is our ability to manage risk, because one of the things in lending, and our kind of head of risk likes to kind of use this a lot, is it's really easy to lend money. It's a lot harder to get paid back. And so one of the things I think that you've seen with a lot of RWA protocols is, they've had really good technology, they've had really good technology teams, but they haven't necessarily had the experience on the underwriting side to manage risk effectively. And I think that's why you've seen as many defaults as there have been in the RWA space, because you have people who, are really technically talented, but don't necessarily have the experience in actually managing a portfolio and managing risk at scale. And so that is something I think really sets us apart. And in a similar vein, a lot of kind of different RWA protocols right now, I almost see themselves as marketplaces, I think, whereas they're looking to match liquidity providers who are responsible for almost doing a lot of diligence on their own to different like private credit opportunities across a variety of sectors. So, you might see on one protocol, let's say like 10 different companies that are all looking for a loan across 10 different sectors. And from an underwriting perspective, if you're trying to analyze these companies to, understand their propensity to repay, or if you're going to get repaid by them or not, there's general metrics across all companies you can look at, right? Like just very typical financial metrics to try to understand, their credit worthiness, but there's sector specific risk in every sector that is a lot harder to understand, especially if you don't have that expertise. And so going full circle on this, that is just another reason why we are really kind of different in a way, in that one, just the experience for our team, and two, our focus is only on the consumer lending sector. We're not looking to lend to companies across different sectors right now, because it just introduces another element of underwriting and risk that we are not necessarily have internally as a core competency.
Yeah, I definitely want to emphasize this, because this is a topic we've talked about with, if people go back to the Diamonds episode, where they talk about, there's very technically adept teams, but then they enter, say, like the diamond industry, like Diamonds is. And it's like, well, you didn't really have the market specific knowledge. I used to work on mortgage-backed securities at BlackRock, and it's like, mortgage-backed securities are relatively complex. Like, you need to know about like TBAs and all these interesting things. If someone just wants to come in from the outside, I'm not saying it's impossible, but it's very difficult to do, because you largely don't even know the problems you're solving for. So talk a little bit about the challenges you guys have faced while building your project, and how'd you kind of overcome them?
So I think the first and foremost thing, and everyone in the space right now is kind of dealing with this issue, but just one, the regulatory clarity, especially in the US. So we are not a US based project. We do not touch the US, and we're not going to be allowing US persons other than accredited investors to actually interact with the Web3 component. And I think in the space as a whole, that is going to be crucial going forward for us to continue to grow, because we spent a really long time just ensuring that we were compliant and doing this in a compliant manner to the best of our ability. And, that is time and money right there. That is really hard for, I think, a lot of teams sometimes to sustain, because, lawyers are freaking expensive for anyone who's ever had to use them, especially in this space, because it's such a specialized niche. They're really good attorneys are astronomically expensive. So sometimes I think I'm going into the wrong field. So I think that's the first and foremost, challenge we had to overcome. One of the things, again, just going back to our team, though, that, you're really fortunate with is, out of our kind of team, one of my other co-founders is a woman named Crystal Grafsky, and she is an attorney by trade and also our general counsel, and has over a decade of experience as a consumer regulatory compliance attorney, and has been in crypto since about 2019. She's been involved in some form or fashion, and so she knows the laws around our space really, really well, and that's been invaluable to have internally.
Absolutely. And let's talk a little bit about, so you guys have overcome all of these challenges. I definitely agree. Like, the regulatory ones are quite difficult. This is often termed as like regulatory capture. Many people think like, oh, more regulations, it will stop like the big players from like being predatory. It's like, well, sometimes you just entrench the big players, because like the big players can only pay for lawyers, because lawyers are expensive.
Yeah, and I think even going back to that, just to maybe give a brief example, without going too into it, the whole idea of being able to like regulate away problems is just a fallacy. If you look even in the US right now, especially with our like system for something like the industry we're trying to disrupt, is there are so many freaking loopholes within the existing laws that allow companies to lend at these crazy high rates, because they're able to kind of work within existing frameworks or laws in a way that allows them to operate, but is kind of interesting how they go about it sometimes. So I would just leave it at that.
Yeah, absolutely. And now I guess we talked about accredited investors, people outside the US. Do you feel kind of the winds are starting to turn and be more in the Web3 favor? It seems like in the past like month we've seen some more positive messaging coming out, but you never know.
So, I think that's going to be something that's going to be really interesting to see over the next couple of years. So clearly, crypto has gotten political in the last couple of months, and I'm not one to kind of dive into politics that much. But, I had the opportunity a couple of weeks ago to actually do a stand-up crypto event put on by Coinbase in Arizona. And we had, individuals at the state level who used to run the financial regulator in Arizona, also on the panel, and also a state senator, JD Mesner. And one of the things that, I kind of heard from some of these other panelists who have spent time in government in Arizona is that the state is becoming more and more receptive to this and this continued legislation. And so I think at the state level in a lot of places, you're seeing a lot more openness. The problem I think we have right now in the US is that, it's great that states are beginning to make a change. And I think that, this bottoms up approach will work over time. It's just going to take a really long time because most of the laws that are applicable for crypto companies are at the federal level. And so things seem to be, moving a lot slower there. Granted, I have very limited knowledge, so, it could be completely off, but at least just from my personal perspective, it seems like things move a lot or are moving a lot slower there. And if it's going to be this bottom-up approach that gets us to a point where we have, regulatory clarity in the U.S., it's just going to take a lot longer.
Absolutely. I definitely echo all those sentiments. Government almost never moves as fast as you'd like it to. And sometimes, let's say slowness is a feature, not a bug. So let's talk about some of the challenges you face as a founder. So we talked about regulatory. Do you find like marketing, fundraising, community engagement, like any of these things to be particularly tricky, or it's really just like these regulatory burdens that are the most difficult?
So I think that our current point in time for, the things that I think have been a little bit more challenging for us at present is probably the marketing side. And I would kind of say that because we are a really unique kind of project within the space. And we've had a ton of traction with people who understand what it is we're looking to do and have maybe more of a background in traditional finance or are interested in kind of social good projects. But I think, one of the things that we're kind of figuring out right now as a team is, we're not necessarily people who are content creators or super social media native, but the regulation's difficult. You clearly have to build out the tech. We've managed to do both of those things. And so now it's like, how do you actually, build a presence clearly to grow interest around your project? And, we've already kind of had the technical skills internally. We had the legal skills, and we didn't necessarily have the kind of community building skills internally. So that's something that it's just, we're learning it right now. And I'm sure we're going to get to a point where we're, fairly effective at it, but it's just something that is not something we were comfortable with coming into actually doing the project. And now we're in a position where it's like, okay, it's time to figure this out.
Absolutely. Yeah. This is a common sentiment we hear on the podcast is that like marketing is always one of the more difficult aspects, is because many people have this idea, like if we build a really great product, people will come to it. And it's almost never the case. It's like, think about the last app you downloaded on your iPhone. It's probably not many. And you're essentially fighting for that attention to try to be one of those people. And if they're not used to something, trying to like educate users as well as like build a community around this, because sometimes the best marketing, once you get people in the door, is like a really great product. But, it takes people first seeing the product to realize it's great.
So
let's talk. First. Yeah, gotta get them in the door first. Absolutely. And this is why, like, if you see movies and you're like, why are all like the chattest guys, the like marketers and salespeople? And you're like, well, it's because like there is no company without that. There's no money.
Yeah.
So there's a little education for my friends. I always talk about marketing for some reason on this podcast. So let's talk a little bit about like how you envision your company kind of leading to the broader adoption of Web3 technologies and like lending protocols in general.
Yeah, for sure. So clearly, as I kind of talked about before, is we are working with another company and actually lending to them on chain, and they're the ones who are originating loans to consumers. And then we are actually just taking essentially possession of the notes after they've been originated. Where we want to get to over time and what we're kind of looking at building out next is figuring out how we actually become a direct-to-consumer lender. And what I mean by that is we want to get to a point where we're still providing, a Web2 interface that is something that, anyone would be used to going to any lender. But instead of having that offered by a third party, is actually offering that natively ourselves. And then if someone's approved from a loan, actually just sending them funds directly from the protocol on chain to essentially their bank account, or provide them like a virtual card or something of that nature. And so for us, we really want to move in that direction, and that's going to tie people in closer to Web3 as well. And so for us, if we can do that and then use account abstraction or use some other things to give people, some initial exposure into Web3, we think that's going to be really, really powerful, because that is going to enable us as a protocol to eventually, we feel, build an ecosystem around kind of offering different services or products to these individuals to meet their different needs, and do it in a way where we are connecting them into Web3, but still providing them with a really seamless user experience.
Absolutely. I heard you use a term that I just want to define for everyone that you could help us with. Is you mentioned account abstraction. For someone that's unfamiliar, what is account abstraction?
So to just keep it super high level, account abstraction is this essentially concept of being able to create a wallet without having to go through the normal process where, you were going into your MetaMask, right? You were generating a seed phrase, and you were essentially responsible for self-custodying all of that and dealing with it. So account abstraction could be something, I'm just using an example from a company I saw at Consensus, is, when you go create a new phone number, they create a wallet address on the back end that's tied to your phone number. So that would be an example of something like account abstraction, where you are essentially giving people a Web3 address or a Web3 wallet that they can use without going through the traditional kind of steps to make a wallet that those of us who have been in crypto for a little bit are used to. But if you, try to expose someone for the first time to crypto, and are like, okay, first you gotta bring funds into Coinbase, and then you gotta transfer them to your MetaMask account. But wait a minute, before you do that, you gotta go into the MetaMask extension, you gotta spin up a wallet, remember your seed phrase, because if you forget that, you lose all your money. And then, oh, by the way, you might want a hardware wallet to connect to that. And if you talk to anyone, who's not, super into tech, or not, under the age of 30, and they look at that and they go, why would I bother doing this? And so account abstraction is going to be, one of the things that eventually gets us to a point, I think, where we can have broader adoption, because it's just going to simplify the user experience tremendously.
Yeah, I even say the UX problem is even more depressing, because that sounded sad, and it's even worse. I would say it's like, okay, send it from Coinbase. It's like, what chain? And you're like, well, I already have to know what chain. And it's like, okay, well, you either have this setting on MetaMask where it automatically imports your tokens, or you're just like, wait, did that not arrive? It's like, oh no, I need to add the Tether contract into my MetaMask. And you're like, oh God, who could figure this out? That's not one of us. Like,
you're explaining like blockchain to someone for the first time or something, and then it's like you said, oh, by the way, send it to Ethereum, and they're like, wait a minute, there's like multiple like blockchains, and then I gotta select which one to send my like coins to, and then wait a minute, if I send my USDC to like the wrong one, I can like lose all my money. It's definitely not the most user friendly.
No, and hopefully, for all my builders out there, let's continue to improve that. This is why I'm very interested in the TON ecosystem, because it just is very interesting to just like have a wallet on your phone. Like, people are very used to Web2 experiences. This is kind of what I thought like the Facebook vision was for Libra, but unfortunately, regulations and yada yada. But just having that Web2 like and the account abstraction on the back end to make everything seem easy. Just make things easy. Not always the easiest thing in tech. So now I'll call this my tech nerd hours. Let's talk a little bit about the stack you guys built on. What is the blockchain you guys ended up picking?
So, pretty simple explanation on this one. So we picked Ethereum to kind of launch on, for the very simple reason that Ethereum is still where the most liquidity is. And so, as a protocol that is reliant upon getting liquidity to lend, it makes sense to launch where the most liquidity is. So in terms of stack, that's where we're launching. And then over time, as we work to kind of do some of this direct to consumer stuff or build some of these additional offerings, as we would look to either launch some future parts of the protocol, or maybe migrate part of the protocol to an EVM compatible L1 or an L2 that's a little bit cheaper.
Yeah, it makes complete sense with the liquidity. And if people go back to the episode with Mina from native.org, you'll see that they are helping solve liquidity, fragmentation, and pricing inefficiencies on EVM compatible chains, mostly on like the Ethereum and L2 ecosystem. But perfect. So finally, where can listeners learn more about your project, get involved with you on social media, call out any links you have, and we'll put them all in the description.
Yeah, for sure. So, we kind of talk a little bit too much about roadmap, so maybe just briefly touch on
yeah, absolutely.
Because it kind of wraps well in this, but we have finished our build out and just actually finished our second audit with Sherlock, for those who are familiar with the audit and competition platform. And with that audit done, we are now on track to actually launch on July 31st. So that is going to be our official launch, where we are holding our ITO, which is going to be our initial tranche offering, is what we're terming it. And that is an initial 1 to 2 week period where liquidity providers can provide liquidity into one of these two tranches, and we'll actually receive an airdrop of ZVE, our native governance token, for doing so. So that event is going to be kicking off July 31st. So definitely stay tuned for more announcements regarding that. And you can find those announcements on our Twitter, X now, but we're not going to call it Twitter. So on our Twitter account at Zyvo Protocol, if you just type in Zyvo, it'll come up. That's Zivoe. You can also check out our website, Zyvo.com. From there, definitely be sure to join our Discord and sign up for our newsletter to stay up to date on our upcoming launch.
Awesome. Well, thank you so much for joining. And everyone, go interact on social media. Go join the Discord. Go, listen for that alpha. We just heard a token launch and airdrop possibilities. So, no financial advice, of course. But stay tuned and definitely interact with Zyvo online and Thor as well. Thank you all for listening to another episode of Building Web3. Get back to building some cool projects.